Welcome back to the deep dive. We're here to try and make sense of, well, a really wild week in the markets. That's October 20th to the 24th, 2025.
Yep.
We've got the daily reports, the weekly outline, and the big picture seems almost flat, but underneath, wow, some stocks were just going crazy.
That's exactly it. And that's what we want to dig into for you, the learner. How does a headline index look stable when individual shares are, jumping 25% one day and maybe crashing 20% the next?
Right.
It's like market camouflage. We're learning to see past that surface calm, to feel the energy underneath.
Okay, let's unpack this. Starting macro, the S&P Sri Lanka 20 index. How did it actually look from the start of that week to the close on Friday the 24th?
Well, if you only look at the broad index, it barely budged. It started the week just, a touch above 6,263.
Right.
So a tiny little bump midweek, maybe past 6,284, like a moment of optimism. By Friday's close, it was back down just over 6,266. So net for the week, almost nothing. Minimal change.
So basically ended where we started. Sounds super stable.
On paper, yeah.
Oh, wait a minute. Index stability like that, it can be misleading, can it? Especially if the index, like the S&P SL20, is weighted towards the really big companies.
Absolutely.
Does that flatlining just mean the giants were, snoozing and completely missing the chaos everywhere else?
That's a really crucial point. You have to think about how these things are built. When those heavy hitters, the large cap stocks, just sit there,
Yeah.
they can mathematically cancel out huge percentage swings in the smaller or mid-cap stocks.
Oh, okay.
So the index gives this feeling of safety, but it's false security if you're holding those other more volatile names. It looks stable macro-wise, but maybe it's not stable at all underneath.
Okay, so if the index giants were asleep at the wheel, where did all this frenzy come from? The 25% jumps, the 20% drops.
Right.
Let's get specific. Show us the proof. Which stocks were really moving?
Yeah, this is where you see the contrast. You got to look at Tuesday, October 21st, and compare it to Friday the 24th. Tuesday felt like, pure speculation driving things.
How so?
Just look at the gains. Huge single-day jumps. Hunters up nearly 25%.
Wow.
Lake House Pren, almost the same, just under 25%.
Yeah.
Amana Tekaful, 24.78%. Hirachandra wasn't far off either, up 18.75%.
Wow.
Massive move.
Incredible gains, if you timed that right. But even on Tuesday, it wasn't all sunshine, was it? There were big losers, too.
Exactly. Even that day, you saw the risk. First Capital dropped almost 10%. SMB Leasing lost over 8%. So the divergence was already there inside the market.
Extreme divergence.
But the real, the volatility carousel, let's call it, kicked into high gear by Friday. That's when you see the sharp pullback.
The reversal.
Yeah, the reversal. And that's critical evidence that those big Tuesday gains were probably just short-term froth, not sustainable. The key thing for you, the listener, is seeing how fast capital can leave.
And the stocks that went from hero to zero are the best examples of that whiplash, right?
Precisely. Take Lake House Pren, huge gainer Tuesday, up nearly 25%.
Yeah.
By Friday, total reverse. It's on the top losers list, down over 9% for the day. But Hirachandra, that's the really dramatic one. Remember, up 18.75% earlier.
Yep.
Friday, it collapsed, down 15.72%.
Good grief.
When you see a stock swing positive 18%, then negative 15% in just, 3 days, that tells you capital just bouncing around like a pinball, chasing the next quick pop.
That juxtaposition is just...
Yeah.
staggering.
It really shows it's not about long-term belief, it's pure momentum chasing.
Right.
And Friday wasn't just about reversals. There were new extremes, too, right? New big winners and losers.
Oh, absolutely. Well, some were falling off a cliff, like industrial ASPH, dropping a full 20%.
20%.
Yeah. But at the same time, new names popped up. Dockyard gained over 19%. Richard Pieris was up 18.75%.
Oh.
So this constant chaotic churning, massive gains, massive losses happening daily. That was the real story of the week. And it was completely masked by the sleepy overall index.
So definitely not a market where everything moves together. It's fragmented. A battlefield, really.
Good word for it. Which, okay, leads us right to sectors. If it's so fragmented, was this frantic rotation happening everywhere, or were people pulling money out of some areas and piling into others? What do the sector patterns show?
Well, it definitely wasn't broad-based. The sector data, especially for Friday the 24th, it just proves the performance was totally different depending on where you looked.
Okay.
Which suggests fund rotation planar, investors actively pulling money from one place and pushing it into another specific spot that was really driving things, not just general market good feeling.
Okay, give us an example. Where was capital flowing to? Which sectors were doing well?
We saw a definite strength in capital goods. The index for that sector moved up quite clearly, which suggests, maybe optimism around things like infrastructure, building projects, that sort of thing. That sector was definitely getting inflows.
And the flip side, where were investors hitting the sell button? Which sectors got punished?
Mainly in consumer areas, actually, especially essentials. Food and staples retailing. Its index dropped significantly, lost almost 50 points just on Friday.
Wow.
And telecommunication services also looked weak, declined quite a bit.
So what's the takeaway there?
The implication is pretty clear. Even though the main index looked flat, investors were being highly selective. They were punishing sectors they saw as maybe vulnerable or just unattractive right then,
Right.
while they crowded into specific plays like capital goods. So you couldn't just ride the market. You had to be in the right sector, probably driven by news specific to that area.
That sets up the why perfectly. If we've got these huge individual stock swings and clear sector rotation,
Yeah.
it must be driven by company-specific stuff, right?
Almost certainly.
Our sources list just tons of corporate disclosures. What do all those regulatory filings and announcements tell us about what was actually moving these stocks?
The sheer variety of announcements listed,
Yeah.
that's kind of the smoking gun.
Yeah.
It really points to specific company-level news, the micro-level stuff being the main reason for those huge daily moves, much more so than, say, big economic news or policy changes.
Okay, let's break down those catalysts. We can start with the most obvious one. Fundamentals.
Right. Financial reports
Yeah.
every quarter, right?
Yeah.
A surprise number, good or bad, especially in a market maybe without much other news, can easily trigger a massive swing.
Makes sense. Then you've got things that directly give back to shareholders.
Exactly. Dividend announcements. You've got your standard cash dividend, which everyone gets,
Sure.
but also scrip dividend announcements.
Okay, hang on. For listeners maybe not familiar, what's a scrip dividend and why would that move a stock price? It's not cash, right?
Good question. No, it's not cash. A scrip dividend means the company pays the dividend using additional shares instead of money.
Ah.
So it actually increases the total number of shares out there. This impacts things like liquidity, future earnings per share. It's basically a way for the company to hold on to its cash, but still give shareholders something.
Okay.
And the market reacts because it fundamentally changes the share structure and maybe signals something about the company's cash position.
Got it. That definitely sounds like a catalyst. Okay, beyond dividends, the list includes major structural changes too. Those must have a huge impact.
Oh, absolutely. Things like capitalization of reserves. That's an accounting move. Turning reserves into share capital often leads to a bonus share issue.
Right.
Then you have rights issues. A rights issue is a big deal. It's how a company raises new money directly from its existing shareholders.
Okay.
It changes the share count. It affects ownership percentages, potential dilution. If you saw a stock like industrial ASPH drop 20%, you'd immediately check if they just announced a rights issue at a big discount.
That makes total sense. So we're going from regular earnings to these really complex capital structure shifts.
Yeah.
Definitely explains the big moves. And then there's the people side.
Yeah, you can't ignore governance.
Yeah.
Announcements about appointments, resignations, retirements of directors, even changing the company secretary.
Yep.
These send really powerful signals about, stability, strategy, who's in charge. In a smaller market especially, if a key CEO or director leaves, that can hit the stock price instantly if investors lose confidence.
And finally, the regulators step in sometimes too.
Yep, regulatory actions, trading halts when things get too wild, putting a company on a watch list, or even suspending dealings entirely. These are often responses to the extreme volatility, kind of like circuit breakers or warnings.
Yeah.
But the main point is this whole laundry list of micro events, dividends, rights issues, board changes, that's the fuel. That's what allows these huge concentrated price swings to happen underneath that calm index surface, micro-catalysts driving macro-level perceived volatility.
Right. We've covered the stability versus the wild swings, where are those stock reversals and sector rotations, and the why, all these corporate disclosures.
Yep.
So let's synthesize. What does this all mean for you, the learner, trying to navigate this? If you had to pick 3 key lessons from this crazy week, what are they?
Okay, 3 main takeaways based on what we saw in the sources.
1.
First, index stability is camouflage. Seriously, don't trust the headline index alone. Those wild reversals, like Harshchandra going up 18%, then down 15%, that proves huge risk and opportunity are churning away just below. The index gives a false sense of security.
Got it. Lesson 2.
Second, Corporate news seems to be king right now, more than big macro stuff. The sheer volume of announcements about dividends, rights issues, board changes.
All that micro stuff.
Exactly.
Okay.
That suggests these company-level events are the main short-term drivers. You really have to obsessively track news for the specific companies you hold or watch.
Okay, makes sense. And number 3.
Third, sector differentiation is absolutely critical. Money isn't flowing everywhere equally. Even with a flat market overall, some sectors like capital goods were getting clear inflows,
Right.
while others, like food and staples retailing, were getting hammered. So capital's being very picky. You have to be specific about where you allocate, not just rely on the broad market.
Fantastic clarity there. So the goal isn't just seeing the numbers, it's understanding the mechanics connecting them.
Precisely.
To really handle a market like this, you need to watch both things. The extreme daily movers, that's the effect. And that constant stream of corporate news, that's the cause. That's where you spot the real value and manage the real risk.
Absolutely. Understanding the why behind the move, what a scrip dividend really means, or the implications of a rights issue, that's what separates making an informed decision from just, gambling in this kind of environment.
Well, thank you for guiding us through that. It was definitely challenging, but really fascinating to see it laid out from the sources.
My pleasure.
And for you, the listener, we'll leave you with this thought to chew on. If the main market indices are sitting still, looking stable, but individual stocks are routinely swinging 20% or more in a single day, where is the hidden risk actually building up? And how long until that hidden pressure bursts out and finally moves the headline index itself?
Good question.
Something to think about. We'll let you ponder that until next time on The Deep Dive.